Welcome back to another episode of the Backholder Pod. So today I'm finally back, but I'm still overseas, so hope everybody's enjoying their holidays as well for all my uni graduate students as well. But anyway, I think even though some of us might be busy, the markets never rest. And of course, the recent FOMC meeting has just announced that they are going to raise by 25 basis points again. And I think in the current market volatility, right, a lot of people have been trying to speculate and try to understand how the market is moving. And right now, the market seems to be pricing a rate cut instead of the Fed just holding it there. So I just wanted to throw it out there. Maybe Bunti, maybe you want to share your thoughts on the upcoming FOMC direction. Whether do you think they'll hold it there, they will actually decrease rates or maybe even increase rates?
Yeah, I think with the recent 25 basis point hike right now, US Fed fund rate already sitting at 500 to 525 basis point, meaning now we are at 5%, So to me, this 5%, although it's just like 25 basis point shock, as in 25 basis point increase, right? But it sounds very different because we are not used to, this kind of big number for Fed fund rate for quite some time already. I think since I started investing, I don't recall I've seen this kind of level. I mean, of course, but before global financial crisis, yes, we have seen Fed fund rate above this level, but it hasn't been this level for some time. So I don't have any special insight to share with regards to where they are going into the future. But what I can provide is that some interpretation from the implied Fed fund rate, which is saying that actually the entire market right now is pricing in a situation where we will continue to see rate cut over the next, call it like 6 months or 12 months, which if I am to guess, I don't think it will be that soon because if you look at the table, right, they're saying like, okay, from September, we see a 25 basis point cut, and then subsequent every meetings, we see like 25 basis point of cut, which I doubt it will be that soon. Yeah, that's my guess.
What about Calvin though? Do you think the market will, or do you think the Fed will actually follow through with the current prediction, or do you think they will hold it there for more pain to come?
I think I just checked this morning. The market was pricing in like almost 99% chance of no rate hike. That it will expect to hold till July and start dropping in September. This 5.25% interest rate was actually the Fed's terminal rate. Fed's prediction back in, I think, was it January or something? Or was it March? Yeah, their last prediction, they were expecting to raise it to this 5.25%. So now they are there, plus the CPI goes way lower. Not way lower, it's still like 4.9%, it's still high. But CPI has gone down quite a bit. So I would expect the Fed to stop for now before they break even more stuff.
Actually, I want to ask a questions here because I think we can ask each other in terms of like, okay, where do you think Fed fund rate will go, right? Actually, we all of us here now, like we are now as economists, right? So we don't really know. But what we know,
I thought we were economists.
Yeah, just for content. No, I'm saying that I'm saying that at least, although we are not economists, but at least we are consumer. Okay, say for example, like I don't know, okay, some of us here have some, like if you want plan to purchase a house, or you want to buy a car, or your car COE just want to, after the 10 years need to renew, right? So will you think that this 5% level, given that it's like sounds quite high now, at least relative to the past few years, do you think this is high enough to stop people from, like making big purchases? Like, okay, even though you plan to buy a house already, you say, okay, let's wait. So do you think it's enough to cool such a purchase or not?
No, I think in the short word is no. Because when they first started raising rates, right, I see all the housing, especially because it's the biggest ticket item, right? They raised the interest so high, but the demand is still so strong. So it really leads me to question, right? People, their earning power is probably much higher than what we think. Because there's a lot of people making noise about all the increases in price, interest rate and all that, but numbers don't lie, you see. Numbers don't lie. And the amount of foreigners that are buying our properties is not exactly that high. I would say about 3 to 6%, thereabouts. just give you a ballpark figure, 3 to 6. So let's say it's 5%. Then who are the rest of the people buying? I think it's pretty obvious is locals, big percentage local, and then plus PRs. So if you have all these people that are earning a lot more, like, but there's still the vocal minority that in the mainstream, they're like, especially social media, they like to complain this and that, this and that. But these people that are complaining, some of them are probably even buying themselves, but they're complaining while they're buying. Like, wow, prices so high, then after that they still go and buy. Yeah. So like I said last episode, I already have a friend who keep telling me that she doesn't want to FOMO, like, oh, it's okay to not do anything. Then after that, she texts me, I just bought a resale EC. So it's when people want to buy, they will just buy. Like they won't like, 5%, 4% interest. Oh, maybe I don't buy. People are still buying. Like you can't blame
Actually,
foreigners.
right. I think now if I can jump in on this, right? I think the 5% doesn't affect Eric because he pays in cash, right? Who needs bank loan? The 5% doesn't affect him. But no, I think jokes aside, right?
No,
I
but
think
how about
certainly,
yourself? How about yourself? If let's say Chicken, I ask you this question, right? If let's say you're not just a graduate, let's say you fast forward yourself maybe like 2-3 years. Let's say 3 years.
He's a graduate already.
Haven't
I haven't get back results yet, so who knows whether I need to
you
repeat
fail
or not.
last semester.
Yeah, last semester.
No, but
No,
can I ask you a question? If you graduate like 3 years already, let's imagine you graduate 3 years already, you propose, you already got engaged, then you say, you want to buy a HDB, right? Do you think the 5% or 4% interest will stop you from buying?
but HDB can take HDB loan, right? It's 2%, 2.1, right?
Yeah. But
It doesn't affect
fresh
me,
graduate, your pay so high, maybe they don't allow you take HDB.
I'm quite sure don't have so high lah. No, as in I get where you're coming from. As in I get the essence of the question. I think from this perspective, it really depends on whether there is a need. So if let's say like immediately you need to start a family or you need a place, you need to get out of your parents' house for whatever reason, then that one bo pian. Even if interest rate is 20%, some people probably still need to buy because they need to get out or they need a family, they need a roof over their head immediately. But if not, actually I think 5% is enough of a deterrence, especially if you're talking about like private housing and like your salary is not here, not there, meaning you're not like 30K per month kind, but you're also not like 3K per month kind. So if you are hovering in the middle and you want to go into private housing, and then the interest rate now is like 5.5% or whatever that banks are offering because you can't take HDB loan, then yes, I think it will act as some sort of a deterrence. But I think to kind of circle back to what Eric is discussing, right? I feel like the 5% effect kind of thing, right, is for Singaporeans, especially. Singapore is a very interesting country, like in a way where you don't really see the interest rate affecting housing demand and stuff. But I think if you look across the globe, right, because Singapore is just a small player in the massive scale, I believe that a lot of all these economic theories still hold true. Like for they plot the curve, right, like in terms of interest rate and demand and how it affects. In a way, I think it will cool down substantially, and it has cooled down for many parts of the globe. Now it's just like Kelvin said, how many more times are they going to do it so that more things are going to break. But in this way, I feel like things haven't necessarily break yet, but we need to see how they kind of move or maneuver this whole thing. But I believe that, especially if I put myself in the shoes, if I don't really have a need, I think I will hold back though. And especially so when a lot of people are already guessing that when are they going to drop rates, when are they going to drop? Because we know that this kind of 500 basis points are not sustainable in the long run. So everybody is expecting for the Fed to drop. So when you're already expecting for it to happen, then more likely than not, you will actually wait for it to happen, so that because it affects you by quite a large amount. Let's not talk about like small loans, but like big ticket loans, like you're loaning $1-2 million. I think those few $100,000 a month is quite a large part of your disposable income in a way. This is just my own perspective on this. What about Calvin though?
Sorry, can I ask you
Sure.
There's some sort of a bias anchoring that you're doing. If you say prices, the Fed interest rate cannot stay at 5%, what makes you think that it can't stay at 5%?
This is not my right. Yes. So this is not my perspective. I think this is just the aggregation of what I see, what people are expecting, like in terms of the noises in communities, the people that are talking about it, and especially a lot of people like all your whatever, like YouTubers, bloggers, whoever, everybody's saying the same thing. So I'm just echoing the sentiments. This is not my perspective in a way where
So let
I
me
don't
ask
think
you your perspective, right? What is a Fed fund rate that you think is sustainable?
I mean equals to long-term inflation expectations lor. So 1.5, 150 to 200 basis points lor. I think those are decent numbers to work with because in essence they are kind of just pacing with how the economy is expected to grow lah, or long-term sustainable growth expectations lah.
Okay, so with that in mind, right, if you think about it, inflation, like somebody said, is very sticky. It's not likely to come down that fast. So although we see that it's coming down, right, do we see the Fed fund rate like following in lockstep with it? Or is there
No, I don't. So here comes the thing. I'm personally side disclaimer here. I mean I'm the most bearish out of the four of you, although y'all can go back to a lot of episodes back. I'm the only one that is bearish of the market. So now you ask me this question. Of course I don't think that it's gonna come down fast. But the problem is when everybody is really expecting it, like in a way where it's a market consensus kind of thing. And to be very, very honest, like what Bunti said, right, over the last 20, 30 years, 500 basis point is unprecedented. And we are slowly seeing things like, oh, this company got issues, this bank got some capital structure problems, and slowly, you're opening cans of worms. So in a way, that's just my understanding of the market. It doesn't matter what I think the Fed is going to do. I don't know, and nobody in the world knows what the heck is going to happen. You only can control your own finances and your expenditure kind of way. So in a way, what you are kind of hinting is, if let's say you don't know what's going to come, you should spend first, right? Or you should try to lock in the rates or whatever lah. To me, I just think that I still think the rates are probably going to come down sooner or later. And if I don't really have a need, then I probably won't buy it immediately. So that's just my baseline. I hope it kind of cleared the air.
Yeah, so my essence of my question to you is, people with needs, right, they will still buy nonetheless.
Confirm. I totally agree with you.
4%,
Yes.
5%, even
20% they also buy. Yes.
20 maybe. I would think
No,
about it.
if you really need a place, if you really need a place and you have no other choice, and then you compare like rental and whatever, you will take the best alternative, ma.
You will
Because
beg your
it
parents.
becomes a need. I don't know. It depends though. Sometimes some people might not be on good terms with their parents, right? So they need to move away. I mean, I'm just speculating here. So that's just, yeah.
While we are on these topics, right, I think also recently the inflation numbers came out. I think it dropped slightly, right? 4.9%, if I recall correctly. So instead of like 5% to 4.9. But when I look at that data, right, sometimes I think about like, is 4.9% number good or bad? Because I recall the market actually reacted quite positively after the inflation number came out. But you need to remember, I think there's this period where the inflation number was as high as, I don't know, like 7+%, right? But that was like, when you look at it, not like the inflation rate, but the price index, right? So when it shoot up by, let's say, quite 7%, it actually compared to like 1 year ago. And then it was like consistently quite high because you keep comparing the current period versus 1 year ago, which was quite low. And this one lasts for quite some time. Then now actually we are almost like, I would say close to 1 year of having entering this high inflation time. So now actually, even if the inflation is 0%, right, you are still, like permanently high price level. So that's why I was thinking, okay, if we compare to 1 year ago, which is already high level, and we still print like 4.9%, actually this is quite a high number. We need to be mindful of that statistics. Like we are now comparing with like high base already. So I don't think this is that good of a result that justify how come the market is so like reacted so positively. Yeah, what you guys think about this?
I think it's good because it means this whole inflation rate is slowing down, and this slowdown hasn't really taken into effect the slowdown from shelter, because shelter is still increased. It increased like 0.4%, 0.4% on the month. But it still haven't taken into account that slowdown yet. So once it really slows down, right, you start to see this 4.9% go even lower by within 2 to 3 months time. this means everything is now slowing down lah. But yes lah, the price has gone up. That is the whole inflation thing going on ma. But now we are talking about inflation rate. So the rate slow down. This means everything is catching up. Then the other thing is the non-farm payrolls increased by 253,000 in April. Still above expectations. This means that the labor market is still hot. But I think like it's all within control. Not everything is going out of control. So the Fed has no real reason to keep raising rates.
No one broken
they just
yet.
need to keep holding it, and everything will slow down eventually.
Yeah. Actually, quite curious because, okay, I recall, let's say, 6 months ago, when Fed started to hike rates, right? We see that, okay, tech sectors, there's a lot of layoff, and then especially US side, like Silicon Valley, a lot of layoffs, right? Then Silicon Valley Bank, and then regional bank, all these First Republic, the banking sectors, specifically the regional banking sectors got some problem. Credit Suisse got problem. We have like at least 2 areas already, right? The question is, what you guys think about which area or which sector that will be the next that will capitulate now, like going down? Do you guys have any candidates to suggest?
I recently saw Munger and Buffett, they did say about commercial real estate, right? I'm quite interested to see whether their prediction comes true or not. But I don't know. I don't have a personal opinion on this.
Actually, commercial real estate, Munger wasn't the first one. Previously I heard Howard Marks, right, in his latest memo, he also talked about it. There's one paragraph towards the end of the memo. He mentioned about the commercial real estates are also quite tricky situations. So that just a recap on that commercial real estate situation is that the occupancy, that's a problem, especially in cities like San Francisco. And then at the same time, just the physical building, they are fine. The building is still standing. It's just that when it comes to the financing part, I think all these banks, they have problem to refinance it as all these mortgage or loan matures. So there's some problem with the capital structure back at the back. So I don't know. I also like still following this, see how big of a mess that it can become.
And the other thing is, like someone pointed out, I think whenever the Fed pivots, the market tend to crash. It's not the Fed causing the market to crash. It's like something crashed, then the Fed only start to decide to pivot.
Correlation.
Lower rates.
Yeah, correlation is not causation.
Yeah, not causation. So I think like this, they will hold for a few months, then something really breaks. Then they're like, oh shit, let's start lowering the rates now. But still no idea what sector is going to break. The property sector is been brewing for a while now already, right? Because everything is slowing down for the property sector. So it might break next, I guess.
China Evergrande 3 years already still haven't break yet. Still waiting, but we'll see how it breaks.
The market is the government is pumping money into Evergrande.
You want to...
But first time, but US also pumping. Are we all not pumping money to support the whole system?
You guys want to hear my prediction?
Yes, do it.
Smash
My prediction
the
is
like
that...
button.
my prediction is that, when something break, right, then there will be people that jump up, say, see, I predicted this. That's my prediction.
Actually, I wanted to kind of circle back about the idea of when Bunty was talking about the higher base effect, right, on inflation. I think there is a key nuance here on the markets is that the idea of market being a forward-looking mechanism, because the entire thing of why markets go up and down is basically just expectations and reality. So in a way where why market reacted positively just means that because it came under expectations, that's why they kind of discount too much and then now they reverse back and try to expect again. So there is a difference between like expected inflation versus unexpected inflation. So if everybody already expects for high inflation environment, things are already priced in. So when it's priced in, you put into your models, you put into your whatever that they do, then markets will react positively if it comes under expectations. I mean, this is in bad terms now. Conversely, it's also true. So in a way, it just means that when markets reacted positively, means that the expectations were bad initially. They over discounted, now they're going to reverse back. So that's just the idea of why markets are reacting that way. But fundamentally, if you look at how the real economy is doing and whatever, nobody cares. As in, at least the stock market doesn't care whether people are losing their jobs and whatnot. And on this jobs part, back to Eric's point on the needs versus wants thing, I think at least in Singapore, the economy is still relatively strong, even though GDP numbers are a little bit shaky now. But I mean, generally, I still see people like graduates still getting job offers and stuff. Slowed down significantly, yes, but people are still getting offers and people are still getting placements. So in a way, the 5%, 6% people taking the loans will still work to a point where they don't have a job. Then when it goes into a recessionary period, then that's the inflection where people start not paying on their loans or whatever. So that's just my 2 cents on the whole thing. But yeah, that's that. Ken? Okay, hope you guys enjoyed the discussion and we'll see you guys in the next video. Oh, and if you guys have any predictions for the Fed FOMC the next round, do feel free to leave in the comment section down below as well. Yeah, we'll see you in the next video. Goodbye.